Ramesh Iyer, the Vice Chairman and Managing Director at Mahindra and Mahindra Financial Services, joining in. Mr. Iyer, good morning and thanks for joining us. The going is very good so far, but there is one impediment, which is perhaps the fact that the monsoons may not be that great. There is the El Nino effect, and that could hit a couple of pockets, whether it's the rural economy, whether it's tractors, even the small car segment. You cater to a lot of these pockets. Are you concerned that growth would slow down? And if not, what is the ballpark range that we're looking at over the course of the next few months in terms of growth?
Yeah, so I think the sentiments are pretty positive even now. And as you said, the numbers look pretty good for us. And this has not been just one quarter. We've seen it over the last few quarters that the numbers are good. And the demand is definitely coming in from all products, all geography. As you mentioned, if the monsoon was to be a little slow for whatever reason, though it's too premature, but even if it was to be, I think the rural cash flow is just not farm dependent. And we have been talking about it several times, that there are multiple sources of revenue that we are seeing. The infrastructure is picking up. So definitely, maybe through monsoon, if there is something that slows down, we definitely believe that it'll be more than offset by the infrastructure opening up and the consumption of assets will happen. So not really much concern at this stage, but definitely we'll watch closely. But overall sentiment seems to be pretty positive.
So good morning, Mr. Iyer. So you're sounding pretty optimistic, and that's good to know, that you're not seeing any kind of slowdown as of now. But Mr. Iyer, what about FY24? You believe that AUM will grow at around the 20% odd, and NIMS, you had said, it should be around that 7.5% plus or minus 20 bips on either side, holding on to both those two numbers?
So clearly, as far as NIMS is concerned, we will hold on for two reasons. One, the product mix change brings better yield. When you do more of pre-owned vehicle, they come at a different yield level. And that's one reason why the NIMS will get protected. Second is we have already passed on 50-60 basis point. That's the impact that we saw in our borrowing cost, while the overall cost went up by 200 basis point plus. But since we have a good ALM match, our impact of borrowing was only about 60-70 basis point, which we have passed on. Put these two together, we don't see that NIMS should be something of a concern. As far as growth is concerned, we've done so far about 45,000 crore, add another 3-4,000 crore normally. So I think this will be our highest disbursement ever for any past years if compared. So I think maintaining a disbursement growth of 20% over this will depend on what's the overall OEM sales. We are retaining our market share and also growing in some segment. But clearly growth is the trajectory. And as you know, we have put out our strategy for 25, which is doubling the balance sheet from 22. I think we are doing pretty well on that.
Mr. Iyer, hi. So I actually exactly want to come to that. If you could elaborate on which are the segments where you are gaining market share and the ones that are really pushing the growth levers for you.
So I think in almost all product, we are gaining market share. I mean, pre-owned vehicle, we are definitely growing. It's not by market share, but clearly the volumes are very, very high. As far as Mahindra Auto business is concerned, tractors are concerned, we were not a significant player in heavy commercial vehicle. There we see traction for us. I think put any product, even if you look at the car segment where we are, and I think in no segment we are doing less. I think we're growing in every segment, and therefore the confidence that the growth would be maintained.
So in terms of rural cash flows, you are not seeing any stress at all in the segments that you cater to? I'm asking because, a lot of the companies, whether it's FMCG, even many of the auto guys, the OEMs that is, have indicated that there is stress in the rural economy and that's reflecting on cash flows. You don't see that situation play out?
If you look at, what are the indicators for the cash flow? One is if the volumes are growing, which means people are bringing in 25% margin and then buying the vehicle. So that's a very clear reflection of the cash flow doing well. The other is the collection efficiency. We maintain 97% plus collection efficiency. You look at our stage 3 and stage 2 are showing continuous decline, and we have not resorted to any major repossessions for settlement or etc., which means that even people who are defaulting are repaying. I think putting all this together, we feel that the cash flows are getting diverted to need-based uses rather than aspirational uses, and therefore you may see different commentary from different set of people. We cater to the use and using segment. People use and repay their installments. They are all buying vehicle, and that's based on the underlying use of these products.
Okay, all right. Mr. Iyer, let's talk about a smaller part of your business as of now, the housing finance business. The gross NPAs out there are very high. But in the past, you were telling us you're expecting the mix to change as well. So tell us, what is the growth you're looking at out there? What about the asset quality? Where do you see this number stabilizing?
So as we discussed in the past, currently we see annual disbursement, the monthly disbursements have become almost equal, rural and affordable housing, which means over a period of time, about 20-25% of the book will come from affordable housing, and our target is to take it to about 40%. Once that happens, the overall ticket size changes, the overall NPA composition changes. We experimented this model by going deep rural, doing small ticket loans for house upgradation, house addition, etc. I think this segment of customers, once they go through some disruption, takes much longer. We don't lose money, but to get corrected will take a little longer. And that's a reason we resorted to a mix change. And going forward, you would see a disbursement growth very clearly. And, it's a small base. We are currently about 8,000-9,000 crore of book. There again, we are talking of in 3 year, a 20,000 crore book with 50% coming from affordable housing.
Okay. Just to go back on the margin point, Mr. Iyer, you did mention that you've passed on the increase in cost of funds to your borrowers. Were you referring more to trends out of Q3, or is this something that you've been continuously doing in Q4? A lot of people are penciling in another 25 basis points rate hike, for instance, in the April policy. How do you see your cost of funds shaping up incrementally? And does the market have the elasticity for you to keep passing it on to customers?
So, in the third quarter is where we passed on 50-60 basis point, and that was the increase that we had to face in our borrowing. Good news for us is we've been upgraded to AAA, and that also gives us a 20 basis point benefit from the market borrowing. And, therefore, even if there is a 25 basis point increase going forward, not necessarily we'll have to pass on. And also, we have increased our pre-owned vehicle disbursement, which comes at a different yield. And therefore, passing on of some rate, absorbing some, of course, and then changing the product mix, improving the yield are the reasons for the protection of the NIMs.
So do you have any further levers to improve your operating efficiencies and bring down your credit costs?
Clearly, the answer is yes. Credit cost is outcome of 2 or 3 things. One, how is the general cash flow of the market that we talked about? They are doing pretty well. 2 is extremely defaulting customers who are not able to earn and pay. We would resort to settlement or take back the vehicles from them. And as you know, on an 18 months old plus vehicle, we are already carrying a very high provision. And those are the customers whom we would target in the next couple of months to make sure that either they settle or they give back their asset for settlement. And that should help bring down the overall credit cost.
All right, Mr. Iyer, I got the point on the smaller part of the business, the housing finance, which the book will go from 8,000-9,000 to 20,000 crores. But what about the asset quality? That's getting a little worrying, right? More than 15-16% gross NPAs. Explain to us why is it high, and also how do you see this improve going ahead?
So clearly, as I mentioned, this was a model that we experimented going more deeper, and then it's the ticket size was a lakh and a half for room improvement, room addition, etc. And they are definitely defaulting, and they are at a high NPA level, but we have seen month after month improvement happening there. And we have given ourselves 2 or 3 quarters before it can come down substantially. And we are confident they would, because there are underlying asset. The LTV was just about 20-25%. So the customers are there, assets are there. It's just that they need to start earning, and we are seeing that beginning to happen. As far as the overall book composition is concerned, as I said, if 50% of what is going to remain rural, and it's 50% going to come from affordable. And if you look at the last 1 year disbursement, the NPA levels are sub 3% and so. So clearly there is a visibility of how the book would look like in a year plus from now. And there is a clear action plan for how do we want to correct the current book.